Hey folks, Chris Versace here. It is Monday, September 30th. End of the month, end of the quarter. And as you can see below, it's been a good one for Tematica's thematic and target exposure models. Roughly 13 of our models are up over the S&P 500 quarter to date. Notable standouts, space economy, and of course, home building and rebuilding America, with those last two really benefiting from the expectation that the Fed has not only started to cut rates, but they are going to cut rates further over the coming several quarters. Now, again, that expectation for rate cuts has helped lift the overall market and our models, but it means that we will have a big week ahead of us as we transition from September into the final quarter of the year. Now, why? Why is this the case? Well, very simply, Fed Chair Powell is going to speak today, so the market will be keying into what he says. Remember, the last thing he said at the Fed meeting was the Fed has delivered a 50 basis point rate cut, and the expectation, if we look at the economic projections, is for another 50 this year and another 100 basis points in 2025. Is Powell going to deviate from that today? Probably not. Why? Well, let's think about it. The only major economic data point that we've gotten as it relates to the Fed's mission of tackling inflation and maximizing employment was the August PCE price index, which of course showed further progress on inflation. So yeah, Powell might recognize that we continue to receive more good data, but the reality is that we haven't gotten any real fresh indication on the jobs market since Powell spoke at that policy meeting. But that will change this week. That's right. As we move from September into October, we're going to start to get that rash of September data. That means several looks at the pace of job creation during the month of September. We will see the ADP employment change report. We'll also get, of course, the September employment report. And folks will be looking to see what happened, not just compared to August, but really over the last few months about the pace of job creation. Is it accelerating, decelerating? Did it come in weaker than expected? All of this is going to play into what the market expects for the Fed. I would also argue that we're going to want to pay attention to the August JOLTS report as well, but also the wage data contained inside the September employment report. And I say this because when we looked at the August personal income, consumption, and PCE price index data we got last week, it appeared that real wage data was slowing and consumption as well as the savings rate were under pressure as well compared to the last few months. So it's going to raise some questions about the strength of the consumer as we move into the holiday shopping season. So we'll want to see, are wages picking back up or are they continuing to soften? That's going to be kind of important. But again, because of the way the data falls this week, we should not expect Fed Chair Powell to say a lot today. There will be, of course, a rash of other Fed heads speaking later in the week, and we'll want to monitor what they have to say. But remember the backdrop here. In addition to that, August PCE price index data last week also brought the latest revision for GDP for the second quarter, and it hit 3%. Not exactly an economy that's rolling over. And when we look at the Atlanta Fed GDP Now model, the rolling forecast for the current quarter as of last week, 3.1%. So again, not exactly an economy that is rolling over, in danger, if you will. If anything, the market narrative is probably somewhere between no landing and a soft landing. And that means that, again, this week is going to start to help fill in the picture as we get the first real hard data for the month of September. So in addition to the employment report and the jobs data I just mentioned, we're also going to get the usual wave of September PMIs for manufacturing and services, both from S&P Global and ISM. And of course, we know that ISM's PMI data will be incorporated into GDP expectations. So we're going to want to parse that data. Is manufacturing, slowing, continuing, or is it picking up? And there is signs that it could be picking up. And when we talk about the rebound in August rail traffic, which continued into September, but also too, is the service economy continuing continuing to carry the overall economy. These are some of the things that we'll be looking at in the data. We'll also get some August construction spending data, and we'll be assessing that as it relates to those home building and rebuilding America models that I talked about earlier. Here's the thing. Should the data show the economy is slowing more than expected, you would argue that is bad news. But in the world of looking for incremental Fed rate cuts, that is likely to be good news and something that the market will embrace. If, on the other hand, the economic data we get is far stronger than expected, that could raise questions about when and by what degree the Fed is going to cut rates next. Currently, the market, according to the CME FedWatch tool, sees two 25 basis point rates coming, one in November, one in December. So that's kind of the economy. When we look at the market, the current narrative has the market trending higher into the end of the year. As much as folks are ready for September to be a bad month, which, as we know, it was not, they are also seeing the market enter what is typically a seasonally strong time of year, October, November, and December, especially as the Fed is inclined at this point, it seems, to deliver further rate cuts, not only between the balance of now and the end of the year, but really into 2025 as well. But let's think about the market. Not to be a Debbie Downer, but it is a little overbought in the near term, and the S&P 500's valuation is stretched. We're likely going to see a little bit of FOMO in the market. Why do I say this? Well, the Fear and Greed Index solidly in greed, and remember, folks are kind of leaning into that market narrative. So at times like this, we have to ask ourselves, what could complicate this picture? Well, there's a number of things. Ratcheting up Middle East tensions and the potential impact on oil, weakening of the global economy. The September PMI data we got for China, I'll just say this, it really helps explain China's potential stimulus plans that were discussed last week. We also have a port strike that's going to begin tomorrow, October 1st, and it could cripple ports and supply chains alike. And of course, there is the 2024 presidential election. And lastly, we do have September quarter earnings season coming up, and it could very well be a mixed bag. So yeah, this week will be an important one for markets as we get any and all economic data, as a handful of companies kind of suggest what we're likely to hear over the coming weeks as other companies report their earnings, but we'll also want to be on watch for earnings pre-announcements, positive or negative. And with that, my friends, here at Thematica, we will continue to focus on our thematic strategies, identifying structural changes in companies poised to capitalize them. Thanks for watching. Be sure to check the data this week, and we will be discussing it with you in upcoming thematic signals. So be sure to check back. Have a great week.